Well, our first guest tonight is here with some advice that may help you with your taxes. He's Tim Maurer. He's Director of Personal Finance for the BAM Alliance, an independent network of registered investment advisors with $22 billion under management. Tim, welcome. Good, as always, to see you. Let's start with this new tax on net investment income. Let's go back over it one more time. Who does it affect? What kind of income does it cover? And how does it work?
Tyler, if you're making under $250,000 of modified adjusted gross income, you won't have to worry about this one this year at least. But if your modified adjusted gross income is over $250,000, then there's going to be an additional 3.8% tax on your net investment income. This is passive income like capital gains, dividends. If you do have a rental property, that could be considered passive income and subject to this tax. In some cases, there may even be annuitized income that is also subjected to this new 3.8% net investment income tax. It really is a seismic shift, even though most people are not going to feel it this year.
If you are lucky enough to earn $250,000 a year in modified adjusted gross income, but unlucky enough to be subject to this tax, is there any way you can avoid it?
Not much of a way, Tyler. I think that one of the things you can do, we're looking at these options to actually look at these different benchmarks of $250,000, for example, or $450,000, where now the new tax rates apply, and look to shift people. If they are right around those limits, we can do our best to possibly limit their income. Obviously, this is not the type of thing that we're typically in the business of doing as financial planners, but it may be something that benefits our clients if they're getting really close to one of those thresholds, like $250,000.
I think it would also, going forward, cause people to want to be much more conscious of the tax efficiency of their investment portfolio and maybe consider some municipal bonds for the tax-free income that they generate.
There's no question, if you have taxable accounts and you're subject to this 3.8% tax, municipal bond income certainly would be something that you'd be looking to do to reduce your overall taxable income. It's also possible, some are suggesting, that actively managed investment accounts are less tax efficient than passively managed investment accounts, and I think there's some real truth to this as well.
Before we get to the higher rate, higher top rate on marginal income, is there anything in that's new this year that would reduce the value or limit conventional deductions?
Reduce the value or limit conventional deductions. Well, I will tell you this. This is stacking on top of, the net investment income is stacking on top of the alternative minimum tax, which is stacked on top of the tax code. So folks are going to be having to effectively prepare their taxes three different ways if their adjusted gross income is over $250,000. That in and of itself does end up having an impact on those other deductions people might be used to taking.
So really what you're talking about here is on capital gains, for example, which used to have the favored treatment, still do, of I guess was 15%. Your total rate on capital gains now could be as high as what, 23.8% when you add in those higher levies?
Absolutely, but in this case, now we're actually stacking the new tax law on top of the net income investment tax. So if you're at $250,000, the net investment income tax comes into play of 3.8. If you're over $450,000 of taxable income, your capital gains rate goes from 15 to 20%. That's how we get all the way up to 23.8%, which is a pretty massive shift from the 15% if you are blessed to have income over $450,000.
Thank you for clarifying that. I was a little confused there. And boy, there's plenty to get confused about, Tim. So that last thought is, you just went to it, and that is if you're a married couple with an adjusted gross income of greater than $450,000, good for you. Bad for you is that your marginal rate now goes up to what?
39.6%. So your marginal rate's going up to 39.6%, and your capital gains rate, for all intents and purposes, is going from 15% to 23.8%. I do realize that this is a good problem to have, but it's a significant problem nonetheless. It's also going to increase the cost of people's tax preparation because accountants are going to have to put a lot more time into these new taxes.
All right, Tim, thank you very much, and happy tax filing season to you.
Thank you very much.
Tim Maurer is Director of Personal Finance for the BAM Alliance.